The formula behind asymmetric investing is working after being up 35.3% in 2024, beating the market by about 12 percentage points. The asymmetric portfolio is up 22% in 2025 to a flat market. This can be chalked up to a few massive winners that I have been buying for well over a year, have been highlighting here on asymmetric investing. Those are stocks like Hims and Hers, Spotify, Robinhood, and the one that was on fire when it was announced that it was joining the S&P 500, Coinbase. That was a stock I was buying when people were very skeptical about the future of the blockchain. So what am I buying now? What sort of stocks have 10x potential over the next 10 years? I'm going to go through 5 today that I still think have phenomenal potential. They've got growth, they've got value, and most importantly, they have the right strategic positioning for the market. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And of course, sign up for my Asymmetric Investing newsletter. That's where you're going to get deep dives, more research, and everything that I'm buying in the asymmetric portfolio. That is the portfolio that has absolutely crushed the market. And I tell all of my subscribers exactly what I'm buying before that I buy them each month. I'll put a link below to both the portfolio and then the frameworks that I have built this entire portfolio around. That allows me to both find opportunities and keep a focus on the long-term vision when the market is going crazy like it has in 2025. And I want to thank this video sponsor, FinChat. FinChat is a tool you see all the time on asymmetric investing. I really think this is a must-have for serious investors, especially if you're a fundamental investor like me. You get all of the data for tens of thousands of companies all around the world. So market caps, price to earnings multiples, you get financial statements, SEC filings, transcripts. But what I love is their KPIs and charts. Their key performance indicators are really a differentiator in finding what drives a company and is the company moving in the right direction. So if you want to see how many vehicles is Tesla selling on a quarterly basis, if you want to see how much an average Crocs shoe sells for, or maybe you want to see how many people subscribe to Disney Plus or Hulu and how much they're paying each month, that's the kind of data that you can very easily find on FinChat. If you go to finchat.io/ASYM, they're going to give you 2 weeks free to try out their pro subscription. And then they're going to give you 15% off if you decide to become a paying customer. I am a paying customer. I still am today. And it is the most valuable tool that I have in finance because I can find everything in one place. If you haven't done it yet, check out finchat.io/ASYM. And like I said, I'll be showing FinChat charts throughout this video so you can see exactly why I find these tools so valuable. Let's get right to the 5 stocks that I love right now. The first one I want to cover is already one of the hottest stocks in the market. That is Hims and Hers. I've been talking about Hims and Hers for over a year now here on Asymmetric Investing. I've been buying it in the asymmetric portfolio. Just a crazy run as I'm recording. Stock is up 366% in the past year. Over just the past month, shares are up 126%. Now, there are some short-term dynamics at play. There's a massive short interest in Hims and Hers right now. And as the stock rises, that puts pressure on short sellers. That causes what's called a short squeeze. That's one of the reasons the stock is going absolutely parabolic right now. But keep in mind, this is a company still growing in triple digits, not double digits, triple digit, 111% growth in the first quarter. That is going to slow down later this year as the exemption the company was using for making compounded GLP-1s during the GLP-1 shortage late in 2024, early in 2025, that's going to be coming off. But what we need to keep in mind is the long-term trajectory and the strategy behind this business. Hims and Hers is trying to become a healthcare platform. They want to be the place that you go to look for healthcare solutions. Whether you're looking to lose weight, regrow a little bit of hair, whether you're facing menopause, they want to keep adding solutions to their platform and be able to connect people with not only providers, so doctors who are going to be able to prescribe treatments, but also with those treatments themselves. That's really the foundation of the business. But we have learned, even just over the past few months, a little bit more about that vision. It keeps getting bigger. And that's what I really like about Hims and Hers. This is a company that only has a market cap right now of about $14 billion. You're talking about a pharmaceutical market. It's worth about $500 billion in the US alone, but they are expanding internationally. They're also adding more non-pharmaceutical products. So if you look at weight loss, yes, GLP-1s might be part of the solution, but what about a fitness plan? What about a nutrition plan? Those are the kind of features that they're going to be able to add to the Hims and Hers platform. Again, that's the way to think about this company, is not just as a product company. This is not just a pill dispensary. This is a company that should be able to provide more and more solutions to people and make it easier to get healthcare treatments. If you have been to a doctor recently, or if you have kids and you have to take your kids to the doctor, you know just how painful that is. You've got to make an appointment. You got to go to the doctor. Then they make a prescription. Then you got to go to the pharmacy. You got to wait in line in the pharmacy. Oh, something's wrong. Now it's going to cost too much. Now you got to go through insurance. There are so many pain points, especially in the US healthcare system. Hims and Hers is answering those, making everything more convenient. And I think that's going to be able to allow them to aggregate demand. This is the key. If they can be the place that people want to go to find their healthcare solutions, that's going to give them a position of power. That's where Netflix is in the media business. People just turn on Netflix looking for something to watch. So if you're a content creator, where do you want to sell your content to? You want to sell it to Netflix. I think we're going to be in the same position in healthcare. where if you are a drug maker, you're going to need to find customers. And rather than going to CVS or trying to sell to individual doctors and have them prescribe your treatment, why not just go to Hims and Hers? Maybe it's a little bit lower price point, but they are building the scale in healthcare. That is going to give them the powerful position long term. I think this growth story is just getting started. And the stock's not all that expensive. Enterprise value to sales is under 8 right now. For a company that's growing in triple digits, even if that growth rate falls over the next couple of years to 40 to 50%, that's still a pretty reasonable multiple, especially when you consider the management has said they are going to be able to expand margins by 1 to 3 percentage points over the next few years. They are hitting on all cylinders. They are building a platform in a massive business. They are founder-led. I love everything that Hims and Hers has going on right now. If you want more on Hims and Hers, I'll put a link in the show notes to a deep dive, a spotlight article that I did on them. I did that in May 2024, before even Hims and Hers GLP-1 products were announced. So I've been in this one for a while. I think there's a bright future ahead. Number 2 today is Joby Aviation, the electric vertical takeoff and landing company. This is really a pre-revenue company, a little bit more of a speculative play than Hims and Hers, but I think this is a market that's just too big to ignore. Joby is building an aircraft, has designed and is now testing an aircraft that takes off vertically like a helicopter, but can fly horizontally like a private jet, like a relatively small private jet with 4 to 5 passengers. The intention for this aircraft is to build a point-to-point kind of ride-sharing service. So they're going to be plugging into airlines and Uber. You're going to be able to go from JFK to Manhattan or LAX to Long Beach, for example. They've got a partnership in Abu Dhabi where they're going to be building a network of vertiports, as they're calling them there. So that's the main business model, is that they want to build this basically ride-sharing platform and get utilization for air travel. I think that is just going to be the start. Another option that they have is to sell aircraft to other operators. That could be personal operators, it could be commercial operators like airline partners. But I think the style of aircraft is going to be something that is going to be ultimately in very high demand. If you've ever flown on a private jet or a helicopter, they are very expensive. I think electric vertical takeoff and landing aircraft can actually take that cost down quite a bit, especially if you're sharing that utilization across a much wider number of people. That's really the vision. And they've designed the aircraft from jump to be very quiet, to be very efficient, and to be very safe. Now, they're not the only competitor in this space. You may be familiar with Archer Aviation. They've gotten a lot more attention, but I think Joby Aviation is the more focused company. We know what the business model is. We know what the aircraft is. And we know what the design trade-offs are. They aren't talking about a million different things that they're going to do. They're much more focused. They're also earlier on in their certification process. So they could reach the skies a little bit before Archer Aviation in an aircraft that I think is going to reach a little bit more appealing to fly in. Now, since this is a more speculative company, it's a little bit harder to value as well. The market cap is under $6 billion. They're going to be adding about another $500 million after an investment from Toyota, but they have the right partnerships. I think they have the right design, and this is opening a market that could be worth billions of dollars per year. The helicopter market worth about $67 billion, private jets worth about $34 billion in annual revenue. I think electric vertical takeoff and landing has much wider use cases than both of those. So it could be an even bigger market. Joby Aviation is one of the leaders. So while this is a more speculative investment, it is one that I'm starting to build a position because I think the future could be extremely bright 10 to 20 years from now. Number 3 is a company that's fallen out of favor. But look, Alphabet is a growth company in every respect. Yes, there's fears that search is going to be disrupted, but search continues to grow in double-digit rates. And that advertising business that really powers search revenue makes its way to YouTube as well, where you're watching this video. YouTube is a powerhouse, over $50 billion in annualized revenue. That is more revenue than Netflix generates. We don't get the full profitability numbers from YouTube, but I think it's fair to say that this is one of the most powerful businesses in media right now. And on top of that, on top of those two segments, you get subscriptions, platforms, and devices. So this is going to be everything from Android to the G Suite. I think about these as the points of distribution for all of Alphabet's artificial intelligence tools. That's where they're getting a lot of pressure from the market. They're not leading in artificial intelligence. ChatGPT has more users. Guess what? Android has far more users than ChatGPT does. That should give Alphabet a leg up in artificial intelligence. And that cloud business that really undergirds their AI efforts is growing like crazy, growing at around a 30% compound annual growth rate. It's now profitable. I think ultimately those operating margins could get up to 20, maybe even 30%. And don't look now, but Google and DeepMind actually making the best artificial intelligence models in the world today by a lot of different metrics. So they need to improve that distribution. OpenAI is definitely a formidable threat from a technology standpoint and from a product standpoint, but they don't have the business model. They don't have the revenue that Alphabet has in that advertising business. I think that ultimately is going to be too much to overcome. And if any company can keep investing on the frontier of artificial intelligence with the massive costs that are going to go into that, tens of billions of dollars potentially to build next generation models, Alphabet's going to be able to do that without going out and raising more money like OpenAI, like Anthropic, like Perplexity will all have to do. So I think Alphabet is sitting in a phenomenal position. And the other optionality that I love with this business is a little business called Waymo that is the leader in autonomous ride sharing. They have more fully autonomous vehicles on the roads than any other company. They're now looking to license their technology to Toyota. A lot of optionality in that business. I think Waymo alone could be worth $500 billion in the next decade. It's that big of an opportunity in autonomy. And investors are getting a phenomenal value. Shares of Alphabet trade for under 18 times earnings. So I think this one is just too good to pass up from both a growth and price perspective. Number 4 is Lyft. This is a company that I've been on for months now, and the market is really just starting to realize what a value Lyft is and what the optionality is for their future. The reason that I'm interested in Lyft in the first place is not because of their existing business. They're always going to be number 2 to Uber in the existing ride-sharing business. That's going to be an uphill battle to be able to catch up to them. So I don't think that's really the opportunity. The opportunity is in the next generation, in autonomy. What does the future of autonomy look like, and who's going to be able to get there first? I think that autonomous vehicles are going to be essentially a commodity. There's dozens of companies that are developing both autonomous vehicle technology and also the vehicles themselves. It's not just Tesla. It's not just Waymo. It's Mobileye. It's WeRide. There's Chinese manufacturers. GM's doing things on its own. So is Ford. Everyone has a strategy in autonomous driving. So to think that every auto manufacturer isn't going to have a fully autonomous vehicle, level 4, maybe even level 5 in the next decade, I think is crazy. And if that's the case, if autonomy in the vehicle itself is a commodity, where is that value going to accrue to? It's going to accrue to the marketplaces who are going to be able to connect riders or demand with supply. What changes the dynamics in the market is who is going to be able to make that transition first. Is Uber going to be able to say, you know what? We're going to put tens of thousands of fully autonomous vehicles on the road, and human drivers, you're just going to have to deal with it. We're even going to undercut you because we're going to lower our prices. I think that's going to be a tough ask for Uber to make that transition seamlessly. Lyft, on the other hand, you're a much smaller business. You have much less supply. So you could go into a city with 1,000 fully autonomous vehicles, drastically increase your overall supply, make your customers even happier, and just say, you know what, we're going to go to full autonomy. We need to make this transition now. I think that's where Lyft ultimately has the advantage. And look, the upside is just too good to ignore. Lyft's market cap, as I'm recording, even after the recent pop in shares, is about $7 billion. Uber's market cap is approaching $200 billion. On top of that, Uber is trading for 4 times sales. Lyft is trading for 1 time sales and just 15 times earnings. They also announced a new buyback program, about $750 million. So if they're able to take even a little bit of market share, they're going to be able to benefit from gaining market share from the business potential, getting maybe 10 times bigger with autonomy, and the possibility for multiple expansion, price to earnings or price to sales, multiple expansion. And all of those things are going to be tailwinds for Lyft with autonomy at the center of it. I think they are much better positioned than a lot of investors think. Oh, by the way, they are also moving into Europe with an acquisition of FreeNow. That is actually a taxi service. So don't think that they're going to be moving into a traditional Lyft business. That's where they're going to be working with fleet operators, but now it's fleets of taxis. In the future, that's going to be fleets of autonomous vehicles. I think that will ultimately be under the Lyft brand even in Europe. So a lot to like about Lyft today. You get a little bit of value and a lot of growth potential. And number 5 is Zillow. This continues to be one of the biggest potential companies in the world because they are aggregating demand in the housing market. Housing is the single biggest asset that most people own, and the value is in connecting buyers with sellers. Traditionally, that was done with agents on a local level. So how do you change that business as you move national and even international? Zillow's solution is to become the housing super app. That's what they call it. So they want to be the place that you go if you're looking for a rental, if you're looking for a mortgage, if you're looking for a new home. And if they can pull demand together on the app for everything related to housing, that will ultimately pull supply. This is another one of these two-sided markets where the power is in aggregating that demand. And every indication is that Zillow is leading that, whether you're looking at rentals or you're looking at home buying. I think the biggest indication of their success long-term is the fact that they are growing so rapidly in the rentals business. That's one of those fragmented markets that's really hard for any company to become the dominant player, but slowly but surely, Zillow is becoming the go-to place. And as it does, it's going to be the place that people are going to look for rentals. And then when you're done renting, you need to look for a new home. Zillow is probably going to be the first place you look. For now, they still rely on the agent infrastructure. I think that will be the case, at least for the foreseeable future. But you could see this be a more digital business in the future where everything that you're doing, from applying for a mortgage to actually making an offer to closing on a home, could happen all within the Zillow app. That's the ultimate future. That may be 10, 20, 30 years from now. But I think this is a company with a $17 billion market cap, has well over a 10x potential over the next decade or two because the opportunity in housing is so massive. So right now we're looking at indications that they're winning I think we're getting a lot of those indications with their growing share in housing and their growing share in rentals, and also a growing business in mortgages. Over time, we want to see that become a flywheel, start to see those margins expand as well. So I think Zillow's sitting in a very good position long-term in housing. So look, even with the hot market that we have right now, there are opportunities, especially if you take a long-term view. That's why I like Hims and Hers, Joby Aviation, Alphabet, Lyft, and Zillow. I will put a link in the show notes to a spotlight article I did on each one of those stocks. I'll also put my asymmetric investing frameworks, which are really the guardrails that I built around my portfolio, and the asymmetric portfolio as well. Thanks for watching, everybody. We'll see you here next time.